In order to be a successful precious metal investor, it is not only necessary to know your own nature, but also the nature of the other players in the game. If you know yourself, then you can craft a strategy of metals accumulation that fits your goals and your personality. But when it comes to understanding the precious metals, most importantly the differences between gold and silver, it is necessary to study the characteristics of those in the market who buy the metal. In this video, we'll take a look at some numbers and discuss the nature of those who purchase the metals. This will tell us some important things about gold and silver that will allow you to make an informed decision as to how much of each you might feel comfortable owning. To keep things simple, I'm going to focus on the physical market and not discuss the paper market. In both the gold and silver market, there are both investors in physical metal as well as industrial users. Both groups have different goals. Investors are mainly interested in the stability of value. They want to know that over time the metals will act to preserve their purchasing power or possibly increase it. The stability of value is largely dependent upon liquidity. In other words, it is important to the investor to know that when the time comes to sell, there will be a willing buyer waiting on the other end to acquire the metal. This means that it is very important that the impact of changes in supply is insignificant relative to the total amount being held above ground. In technical terms, this means having a high stock-to-flow ratio. When we see that the inventory of any commodity is very high relative to the production and consumption, then we know that people are holding it because there is value in just holding it. It means that they are willing to absorb and hold additional amounts of the item regardless of how much they already own. This concept of the last unit of an item being just as valuable as the first unit is known as constant marginal utility, and it is a defining characteristic of money. Investors also use the precious metals as insurance against currency failure. This means that whatever they hold will have to increase in value significantly in the event of a sovereign default. Of course, not every item can rise arbitrarily in value when they need to function as money without having a significant impact on demand. Only monetary metals can do that. We also know that the metals investors are interested in portability, ease of storage, and low investment costs. Now, the industrial users are very different from investors. This group has a vested interest in keeping the metal priced as close to the cost of production as possible. That's because the metal is a raw material, and so it represents a cost to them. They are also interested in ensuring an uninterrupted supply of metal. This is why user groups such as the Silver Users Association are formed. Another important feature of the industrial users is that they don't want to maintain a significant inventory of the metal. Any investment made in inventory is money that is not being put to work. The users are only interested in turning a profit, and so they will want to keep their inventories to a minimum so as to minimize working capital. So with all this in mind, let's take a look at some above-ground stock numbers, some production numbers, and some purchasing numbers to draw some conclusions about gold and silver in general and see how they compare against one another. The mines of the world produce a much greater amount of silver per year than they do gold in terms of ounces. But we can see that gold in terms of total dollar values is a much bigger business than silver. While 8 to 9 ounces of silver are produced for every ounce of gold, the gold mining industry is a $120 billion per year business at current prices, whereas silver is only a $16 billion industry. Both metals are consumed by industry. The silver users consume about 470 million ounces of silver every year, mostly in non-recoverable applications. The gold users consume about 13 million ounces of silver per year. Of course, due to the differences in the value of each metal at current prices, the dollar value of the metal consumed each year is similar in terms of order of magnitude. After we account for the amount of metal used in industry, what's left over needs to be absorbed by the metal investors. We can see here that investors each year buy about 79 million ounces of gold and 310 million ounces of silver, which is roughly a 4-to-1 ratio in terms of ounces in favor of silver. When we take into account the current pricing, we can see that investors currently have to absorb about $103 billion per year worth of gold and about $6 billion per year worth of silver. This is about a factor of 17 difference in terms of the total amount of cash that the investors pay for one metal relative to the other. What is very interesting is when we take a look at the current above ground stocks, My best estimate being that there's 5.1 billion ounces of gold in above ground stocks. Of this, only 1 billion ounces are being held by governments. The rest is held by private investors. There also appear to be 14 billion ounces of silver when we compare the historic silver production statistics against consumption statistics. Almost all of this silver is held by the public. When we compare the dollar value of the above ground stocks at current pricing, we can see that the market value of gold is about $6.6 trillion, whereas the dollar value of the silver is only $289 billion. Thus, the gold investors have 96% of their metals allocation in gold and only 4% in silver when looked at on a currency basis, in terms of current valuation at current prices. Many will say that this is a great argument for why silver is so undervalued. I can't support that claim or refute it, but the statement that silver is undervalued seems to go against the collective opinion of the vast majority of those who hold the physical metal. After all, if silver was so greatly underpriced, then why would the metals investment group as a whole hold so much gold in dollar terms relative to silver? Why wouldn't they just use their purchasing power to bid more silver away from the industrial users? Well, there are good reasons for this. For one, many metals investors are interested in portability and ease of storage. At current pricing, the same dollar value of silver would require 120 times the amount of storage space. This is not only inconvenient, but it's not very cost effective either. The other reason has to do with silver's dual role as an industrial commodity and the volatility that use creates in its value. Now, I'm not saying that silver is a bad investment. I personally own some, and I think it's a good investment, but for different reasons than gold. At the same time, it's important to recognize the strengths and weaknesses of both metals. So let's proceed by taking a little bit more of an in-depth look at stock and flow. As I mentioned, some of gold production goes towards industrial use, but the 13 million ounces that are used each year in industry only represents 14% of the new supply. The remaining 86% is purchased by the investment community. Contrast this against silver, where the 470 million ounces represent 60% of new mine supply, leaving the other 40% to be purchased by investors. So whereas gold's demand comes mostly from investors who intend to use it as a store of wealth, the bulk of silver's demand comes from industrial users. These users have an interest in buying silver at as low a price as possible, storing as little as possible, turning it over quickly, and then selling it. Another item to note is that because of the very small quantity of above-ground silver stocks, the total silver stock must grow at 2.2% per year to absorb the silver that is mined and not used by industry. The gold stock, by contrast, only needs to grow by 1.5% per year to absorb the unconsumed supply from the mines. So we can see that gold and silver have distinctly different characteristics. These characteristics are not necessarily inherently bad, but if you're buying one metal or the other, they can be pretty important. For example, if your main focus is on wealth preservation, then gold is probably your better bet. It is, after all, the same bet that has been placed by the bulk of the metals investors on the right-hand side of this slide. But if your goal is to grow your wealth, then there are times when investing in silver can make a great deal of sense. But to do so requires much more attention to be placed upon mining supply and industrial demand, and timing is very important. Let's see how the industrial demand for silver changes the potential growth versus stability consideration. Let's suppose that in a given year, industrial demand for both metals stays the same. Let's further suppose that mine supply changes by 10%. We can see here that the change in the amount of gold that must be absorbed by the investment class changes by 12%. At the same time, the amount of silver that must be absorbed by the investment class changes by 25%. Thus, the presence of industrial demand in silver can really change the stock-to-flow consideration and cause much larger swings in the silver supply available to the investment community when mine supply fluctuates. Of course, volatility is not necessarily a bad thing. If you buy at the right time, then the volatility can really play in your favor. If you buy at the wrong time, the volatility in silver can be very punishing. Gold, on the other hand, is much more stable in terms of stock-to-flow. Let's take a look at what will happen if industrial use changes by 10% instead of mine supply. Now here we see a very profound difference in the properties of gold versus silver. A 10% change in industrial demand for gold changes the amount that must be absorbed by the investment world by only 1.6%. By contrast, a similar variation in industrial silver demand changes the amount that must be absorbed by the investment community by 15%. Thus, the sensitivity of the stock-to-flow of silver is 10 times higher than that for gold. But again, if you can play the volatility to your favor, you can make out very well in silver. You just have to be aware that you cannot ignore silver's dual role as an industrial metal and a precious metal. This is one of the primary reasons why silver will tend to perform very poorly when the general economy turns down. Sure, there will be people who will seek silver as a tangible item that can preserve wealth, but at the same time, since 60% of the demand currently is industrial, the wealth preservation qualities of silver can take a back seat to that. This is why we can see behavior such as what we saw in 2008 and 2009, when the economy turned suddenly weak and the price of silver declined much more on a percentage basis than the price of gold. Large investors with lots of wealth aren't interested in making money off of silver, but in preserving the wealth that they've already got. Besides, really big investors can't take advantage of silver's price volatility, at least not in the physical world, primarily because the wealth generated by doing so would not be meaningful in the grand scheme of things. Not to them, anyway. You, on the other hand, can take advantage of silver's volatility, primarily because it's such a small market. At the same time, you just have to be knowledgeable about the factors that affect its price and act accordingly. Timing for the silver investor is very important. The gold investor, on the other hand, won't have as much excitement in his life. But the gold investor can take comfort in the fact that he or she is following in the footsteps of giants.